Hey everybody, it's Erik Torenberg, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Phin, take it away.
Cool. Yeah, no, thanks everyone for making some time to listen. Hopefully it will be more of a conversation, a webinar versus a conversation. And so I have a bunch of notes that you'll probably see me reading from, but as I try to organize my thoughts. But please jump in with questions and push me on things to the extent that something's not clear. So yeah, so as Erik said, I was at First Round most recently, and before that I had a fitness video game startup, and I was the creative director at And1. Sort of coming out of college, and that's sort of my professional career so far. While I was at First Round, I got to work on a ton of things, build partnerships with companies in healthcare like Patient Ping and Clover Health, sort of in the low code, no code, whatever you want to call it space, like Notion and Glide and Clay, subscription economy, Blue Apron and Birchbox, and also Steady, Clearbit, Persona, Modern Fertility, some others. So got to work with some amazing entrepreneurs and got to build some things like Dormer Fund, Angel Track, and recruit partners, and sort of help to take the firm from 4 partners and 4 admins and a CFO when I joined to sort of what it is today, which is like 43 people and a huge platform, et cetera. And so sort of happy to share my point of view on any of that if folks sort of offline are thinking about joining a firm or starting one, have a lot of thoughts about what makes for a successful partnership as well as for successful firms, brand building, et cetera. The thing I wanted to talk about today and something that I sort of studied over the last 10 years at First Round is the concept of the founder interview. And I think that when people decide to shift from their primary attention being on operating to investing, it is one of the skills that you can really focus on and get much better at. And so I wanted to talk through a couple kind of foundational beliefs that I hold around investing, and then I'll go into some specifics, hopefully actionable for you all, around questions you can ask and areas to push on. And then a second piece on specifically how to think about asking those questions so that you get the best information. So first, I think I would say, in my experience, investing is simple, but it's super hard. And simple meaning the things you need to do are pretty obvious. Access great entrepreneurs, decide which ones you want to partner with, convince them to partner with you, and then support them in their success, and then repeat the process. And so I think that it's simple, but each of those things is very hard. And hopefully this 20, 40 minutes, whatever it ends up being, is a way to help you get better at the decide part and also some of the win part. So a second thing that I've come to believe about investing is that your investment partnership is a product that a founder buys with their equity. As an investor, you're definitely on the sell side. And I sort of think about that as like every time an investor has said yes to a founder, given them a term sheet, in that moment, you're effectively saying, your equity is worth more than my money. Like, please take my money. And so you really need to think about being on the sell side of the equation rather than the buy side, where you sort of show up late to meetings unprepared and sit back and ask someone sort of what they've got for you. It's also a hard product to generate a high NPS because you need to earn, high satisfaction from customers, but you're in a world where 99% of customers don't get what they want, because just by the odds, you're going to say no to 99% of people. And so you have this problem as a PM of your investor product, that you have to create something that people will refer to their friends even when they don't get what they want. And so I think the way you actually approach the interview with a founder, your engagement with them well before the investment, is probably your highest leverage point of distribution for your reputation in the market. I think there's clearly you can do things that help founders after you've invested, but the vast majority of founders you interact with, you're never going to invest in. And so really focusing actually on how you want that product, the pre-investment product, to be perceived is a critical piece of kind of building your reputation as an investor. I don't think there's a right way to be an investor, but I think I've seen lots of wrong ways, both as an entrepreneur and as an investor. And I can't tell if it's correlation or causation, but in my experience, like being an investor makes most people into arrogant assholes. There's just sort of this incredible thing that happens when you have money. All of a sudden, there's this power thing that you assume, and people start to act in ways that they maybe wouldn't have expected. I think it sort of erodes empathy for the founders, and it tends to amplify a sense of importance, intelligence, foresight, whatever you want to call it. And I think that these are things that you really need to be hyper aware of, both in yourself, but also because as you act as an investor, when a founder meets you, they're bringing a lot of expectations to that meeting, and so they're going to, in some ways, interpret a lot of things that you do through the negative lens that comes from the reputation that many investors have, and sort of the ghosting and blowing people off and some of that arrogance. I think you have to be hyper sensitive, because even if what you're putting in the world is neutral, it can be interpreted as negative. And so for me, I was thinking back on when I decided to become an investor, and sort of what that meant, how I could get better. And what I've come to is being an investor, your job is basically to apply your judgment to information that you have about a company. And then when you're able to find a partnership with that founder, then you do everything you can to support their success. And so if you think about that as the fundamental role, and you want to think about how to get better, you can improve the quality of the pool that you're fishing in. So you can work on your network and your access, and hope that on average, all the founders you meet with are better, and therefore the selections you make will be better companies. You can improve the quality of the information you have. So what do you know about the founder? What do you know about the company? What do you know about the market? And hopefully that helps you make better decisions. You can improve the quality of your judgment, but I think the only way to really do that is through experience over a long period of time, and the feedback loops are very long. And then you can improve the quality of your support that you offer to founders, which is effectively coaching. And so for me, in joining First Round and then thinking about how to get better, I really became obsessed with how to improve the quality of the information that I was gathering. So the interview, which is what I'm going to talk about mostly today, and then how to improve the quality of the support, which was the coaching. And the reason that I picked both of those things is because my experience in becoming an investor was lots of people telling me, "Oh my God, that's amazing. Congratulations. Now good luck and go find the next Stripe, Uber, Facebook, whatever it is that was their point of reference for a successful company." And it just wasn't very helpful. But if you break investing down into those commiserate pieces and you focus on interviewing and coaching, each of those topics is broadly written about, studied, etc. There's lots of approaches to both, so you can kind of pick and choose. Like interviewing, you can interview like a recruiter, you can interview like a journalist, but you can interview like a law enforcement person. Coaching, like an executive coach, like a life coach, basketball coach, and so I think there was lots of examples that I could sort of draw from. What I've tried to do in sort of drafting out some thoughts to share with you all is take my lessons from, I went back and looked, and I've partnered at First Round and as an angel with 63 founders at this point. I think my average is about 150 to 1 in terms of meetings versus investments. So that's 9,450 interviews. And this is sort of hopefully a summary of the things that I've learned and organized in a way that's actionable, for you all. So the first thing I would say, because most of you are operators, is there's this thing when you think about the analogy is sort of chocolate souffle or brownies, right? And if you think about chocolate souffle or brownies, they have a lot of the same ingredients, right? And so the danger of being good as an operator, whether you're in product, engineering, BD, whatever it is, and then you decide to be an investor, is that when a founder comes to you and they start talking about, the chocolate, the sugar, the butter, the milk, cream, etc., how they're going to put it all together, in your head, you're saying, what would I do with those ingredients, right? And you're imagining this like molten center chocolate lava cake and this souffle cake. And so then you decide to invest, right? And you tell the founder, like, I'm in, this is amazing, I can't wait. You wire the money. A month later, the founder comes back with a tray of brownies and they say, look what I did. And you say, oh my God, what did you do? This is horrible. This is not what you should have done. And you're really upset about your investment because you wanted chocolate souffle and they came back with brownies. But the truth is, in the first meeting and in every conversation you had with them, they were talking about brownies, but you didn't hear it because you were thinking about, what would I do with my operating expertise with these ingredients. And I think that mindset shift from what would I do with this opportunity to what is the founder going to do with this opportunity is a critical thing as you think about sort of taking what you know as an operator and applying it as an investor. And so when you try to start doing that, I think you want to remember that a successful use of your time as an investor is when you spend time with the founder, you're gathering information. The goal is to support you making a great decision. Yours is to create a good product for the founder, but the goal of that time is for you to make a better decision. And I think that when you do that, the thing that was most helpful to me was shifting from sort of open-minded curiosity when I met with founders to coming into that meeting with a position around the business, what was exciting. Obviously, something was exciting because I decided to take the meeting in the first place, but with a specific point of view that I was trying to ask questions about to validate or disprove my beliefs about the company, so that I could ultimately get to a yes or no on the business. And I think as you go through that time with the founder, always having a position at each moment as sort of new information comes out as to whether you're closer to the thesis that you had and more excited, further from the thesis and less excited, or maybe further from the thesis but even more excited than what you thought coming in. But remembering that like your goal in that meeting is to get to a yes or no, or identify additional kind of open questions that will help you make a better decision to sort of validate or disprove your assumptions about the business. You can make a list of kind of, facts that you want to validate, assumptions that the founder has that you want to push on with other folks that higher level questions about the CEO or team dynamic, these types of things, writing them down to be able to then leave that meeting, go do that work and come back to the founder, ultimately with an answer. And so I think when you think about doing that, you want to structure the interview, right? And if you've done recruiting, everybody talks about structured interviews being much, much better than just random kind of conversations. And I think that you can actually get very good at structuring the interview with a little bit of prep work. It doesn't take a ton of time. And, everyone will tell you like they have some version of asking about product and market and team and figuring out what you want to know. And I'll get into some of that. But I think those three things miss one really important ingredient. And this goes back to product, which is the missing ingredient is the relationship or the tone that you want to set with the founder. And you want to do this for two reasons. One is it will dramatically affect the quality of the information you're able to gather. And then two, it'll affect your ability to win, to get allocation in the opportunity, should you decide that you want to. And so I think when you think about that relationship, that should be your highest order bit. People talk about recruiting for companies, and I know some folks that will spend the first sort of 15 minutes of any interview making sure that if the next 45 minutes go well and they want to hire the person, that person will say yes. And so it's almost like the opening 15 minutes is like a sell job. I don't think you need to go that far, but I do think that you want to make the founder super comfortable, feel respected, and make sure they know that you care about this time you're spending with them, that you value the time. And I think in doing that, you get to ground truth much more quickly. You get the founder very comfortable expressing what they really believe about the opportunity, why they're going after it, how they see the world, and away from sort of the sales pitch, which can be sort of like the talking points. And then also because you're showing them a tremendous amount of respect when you ask to be included in the investment, I think the probability they say yes, I think goes way, way up. And so I think focusing on the relationship is super important. I think a lot of people jump right to the questions about sort of product market team to make your investment decision without remembering that one, you want the truth about that stuff, and then two, you want the founder to say yes when you say you want them, when you say you want to invest. And so I think to that end, like questions that expose you've done some work, right? So, and you care about them as a person, right? Where are they from? What brought them to the Bay Area? If you're in San Francisco, or now we're virtual, so knowing where they're calling from, or like why are they spending time in Provo, Utah? If you've done some background work on them, right? If you see that they worked at a company where someone, asking them if they know that person, right? Oh, I saw you worked at Twitter. Do you know so and so? Even if they don't know the person, it shows that you've thought about them, you've done some background work, and you also have this sort of secondary connection potential to their life and the work that they've done. And I think as you get through that, then you can also ask people, general softball questions like, what's your purpose with the company? And everybody loves to talk. It's an easy, positive question. It sets the meeting off on a really positive foot because they get to talk about their vision what they're most excited about, why they're doing this thing, before you get into some of the hard questions about how it's going to work and why they're going to win. So I think focusing on the relationship is super important. Second thing is in product, and I think here I always sort of said it's less about evaluating the product itself. Like some folks maybe are really, really good at product and can make decisions based on actually the quality of the product in front of them. For me, I always sort of viewed the product as a proxy for like an opening for how did the founder make these decisions? It gives you an opportunity to ask questions about, why is the button blue or red is much more important than whether I think it should be blue or red. And so I think talking to a founder about the product decisions they've made, encouraging them to demonstrate sort of a deep understanding of the customer problem as well as the product ecosystem, to show off, what they know and why they're doing it. Some things I like to ask are like, for example, can you explain to me like a 5-year-old what problem you're trying to solve, right? And have them really dumb it down, make it super simple. What is the problem you're trying to solve? And then you can go through a litany, like, right, like, does your user know they have this problem, or not? And if not, why not? How do they solve the problem today? What tools do they use today? How do they become aware of those tools? What's the decision process prior to adoption? All of these things, you can sort of run down these rabbit holes around how deep has a person gone on the customer problem and the product that they're building. When you think about the solution, you want to make sure obviously it's solving that problem, but also that it's unique or defensible in some way. I think you can ask directly, like, what is unique? What's the unique value you're going to offer? Why is it different? But then I think you can go further and say sort of, okay, if that's why it's different or unique, what are the product principles that are key to delivering this value to the customer? How are you going to do that? What are you optimizing for? And how do those key principles then impact your approach to product management, who you hire, the sequencing, the way you go to market, all of these things? And you're looking for consistent sort of through lines in the founder's narrative as you dig on these questions that I think tell you a lot more about how they think about product rather than just evaluating the product itself and, oh, it's beautiful, so therefore they must be good at product. What makes the product easier to use or more valuable for a first-time user as you scale, as you add features? What makes the product harder to stop using over time? And why does it get lock-in? And making sure they understand these things. And so I think when you think about asking about product, which is critical, what you're trying to get at, I think, is their product mindset more so than some evaluation of the actual product that they've already built, or even the mock-up that they're showing you and sort of how well designed it is. As you move to market, I think you really want to figure out from the founder's point of view why they think this category needs to exist, and what the world will look like if the company creates or dominates the category that they're going after. I think I tend to focus more on how they read the market, sort of the forces that are at play, the competition, the structure of the market itself, sort of the architecture, rather than the size of the market. I think more great investments have been missed because people thought market size was too small, and either didn't understand how large a niche could be, or didn't understand how actually market creation would occur, either because of some fundamental technical change, societal change, or some insight that somebody had. And so I think in that case, looking for clarity about the market forces, and sort of asking about, what do they see as the structure of the market? Who are their competitors today? Why is it that way? Why has this market that they're going after evolved in this way, where you have a couple dominant players at the top, or where it's fractured and you have lots of service providers and you're going to roll them all up? What do they think will happen over the next few years? And is there some trend or fundamental shift that they're riding to success that they're sort of seeing before others? And how do they plan to do that? I think as you do this, you can listen for the assumptions that they're making, which I think is a great way to, I'm not a fan of case interviews, but to the extent that you hear a founder express an answer with an assumption, being able to push on that and say, okay, but what if that plays out differently, right? Like, what if margins actually don't expand and, you're not able to charge the way you think you will in this premium way? What if that doesn't happen? What will you do? What would be the first sign that this is happening? Like, how would you know this was starting to happen? Would it be a competitor kind of undercutting you and offering part of your service for free? Would it be someone accepting a loss leader because they have like a bundled product and you're just coming at them with a single solution, et cetera? And then how would you adjust? And so I think getting into the game a little bit of seeing how the founder deals with uncertainty, the way they think about adjusting to a new sort of piece of information or a new landscape that come around a corner and it looks different than they expected, is a really great thing to learn, particularly in a first interview, because the only thing that is certain is they'll face tremendous uncertainty, and you're effectively at the highest level betting on like a founder's ability to navigate that. And so I think being able to ask specific questions that reveal some of how they would do that is much better than sort of grinding somebody on like the way they figured out TAM, which just doesn't sort of seem super interesting. And then I think the last thing to push on, particularly early, and it's much more important than ultimate size, is, you know, how are they going to hack into the market to start the company? Like, what's their unfair distribution advantage? How do they plan to get sort of some sense of leverage distribution and, you know, be able to get the product up and running, get the flywheel spinning in some way that's unfair, that potentially others don't have, or that really leans on their unique insight. So like Steady, for example, is a new EDI company. He comes out of the auto parts space. And so he found a way to partner with this auto parts distributor as a way to test his beliefs about EDI, how he could create forms that would get small vendors on, et cetera, et cetera. And so he sort of had this like development partner early, but this development partner happened to have a very, very large audience of lots of sizes. And so that helped him get to market. That's just one example. And then the last bit is on team. And team obviously is critical, and everyone has their own sort of taste in teams. And I think this is the area where, you know, it's completely subjective. But I think, you know, you need to make sure you're picking a team you believe is suited to the opportunity, that can deliver sort of in the near term. But I also think the reason taste here really matters is because you want to pick sort of folks that seem reasonable to work with, and that you in particular will be excited to work with. And so I think, you know, I tend to look for like people with a deep need to win, but not take credit. Skilled storytellers, because I think that impacts recruiting, selling, fundraising, you know, and then seem reasonable to work with in terms of how they take feedback and their level of curiosity, the stuff that they're excited about, whether they wear good sneakers or not, all of those things that are important. And so I like to ask a couple things about team, you know, to understand their process. Like I tend to ask them, what was the last idea they said no to before they committed to this? And why didn't they pursue that idea? Like, what was the thinking? And that one's super easy because people can be analytical in a negative way, and it gives you a sense of how they might say no to things as they lead the company, which I like. I think to understand their priorities, asking people sort of what's the most important thing that happened at the company in the last week is a great question, because one, there's always something, or at least there should be. Two, it's a positive and they're excited about it, so they like to talk about it and talk about it a lot. But then three, the thing they pick is probably more indicative of what they think is important to the company than if you just ask them sort of, you know, what are your priorities right now, right? And so I think you can get at some deeper understanding of the team by asking questions that sort of carry multiple meaning. There's also you know, things around ego where, you know, I think if you have concerns about team dynamic, one of the hacks I like is if there's two people in the room, talk to the one that's not the CEO and just see how long the CEO will tolerate being ignored. And it can be a little socially awkward, but it works pretty well. And you can also see when, you know, if you're typically it's like CEO, CTO. And so if you ask the CTO a question that's more appropriate for the CEO, do they try to answer it because they never get a chance to talk in any meeting? And so they want to take stage, you hand them the mic and they want to use it. Or do they appropriately sort of pass it back to the CEO in that case? So those are just kind of some tactical things around product, market, team, and relationship, and what I like to ask. The next section that I wanted to run through, and it'll take about 10 minutes, is sort of thinking about actually the how, like how you actually set up the interview. And so I don't know if folks have questions on the what to ask. I'm happy to jump in or just keep going on the tactic, sort of the how to set up an interview. But you guys let me know.
Yeah, I have a quick question. When
Sure.
you're talking to a founder, you kind of see them as a like a final product, so to speak, and like think about their context for today, whether you want to invest or not, or have you ever done where you like think they're missing some aspect and then mentor them to get there and then fund them?
I think you can do both. I've done both, and I think usually though, you know, you're not looking for well-rounded people. You're looking for people with spikes that you can potentially amplify. And so in the cases where I've done what you're saying, which is sort of you talk to someone you don't quite get there on feeling like you want to invest yet, but then you continue to be in touch with them, continue to support them, and then the round comes together maybe later and you're able to participate. I think that's what you're saying. I've definitely done that, but for me, it's been a process of figuring out how to amplify their existing strengths rather than figuring out how to mitigate some weakness that I'm concerned about, for what it's worth. My last investment actually through first round was an example of that. There's a company called Iggy, and Lindsay is amazing. And I was talking to her. She's doing basically Clearbit for geodata, and she was moving from being a data scientist, product manager to being a CEO. And the nice thing was we sort of had time as she was in an accelerator to talk through how she was thinking about that evolution. And I probably spent 4 months talking to her every other week before we got to the point of investment, which was great. And we get to build a real relationship before the investment. The other reality, though, is the market moves so fast right now that it's oftentimes when a founder is taking time to talk to an investor, at least when I was sitting at first round, it was typically the case that they were raising money, and so I had to decide more in the binary in the moment. I think as an individual angel, you probably have more opportunity to kind of get to know folks and maybe talk to them months before a round is coming together.
Thanks.
Hey, Phin. I was kind of curious. It's like, I like your approach of trying to stay as neutral as possible as going into a deal, but I'm kind of curious if you have experiences of when you went predisposed to either like or hate a deal going in, and if the interaction actually changed that to the other way.
There have been times where I've gone in hating something and came out liking it. But those are only in partner meetings because I wouldn't, or where another partner asked me to take a meeting. Because if I don't like something, I would never waste it. You don't want to waste the founder's time if you're even 49% yes, right? I think you should only take a founder's time if you're pretty excited and you want to sort of validate what you're understanding. And that could be that you're not so sure about the business, but the person's amazing, right? It doesn't have to be a complete picture. And so I think many more cases where you sort of I've been excited about what my understanding was from reading a deck or a referral from someone, or maybe a quick phone call with a founder, and then had a meeting and realized that my excitement was either a local maxima or completely fucking wrong. And the thing I should really be excited about was this total other thing that I missed entirely, right? So with Glide is a good example. When I first heard about Glide, I was like, oh, it's like an app builder. Who cares, right? This is it's an app builder and the guys are smart and but how many mobile app builders do we really need? And, if you go back to some of Mobile Roadie and some of these other things that sort of, they never really found these big audiences. And so why should I care about Glide? But the teams from Xamarin, they're super smart. I have a chance to meet them. They seem like they're getting some buzz in YC. I can meet them a couple weeks before demo day. I'll take a 45-minute meeting. As I sat down with David, and what became very clear to me in that first meeting was the thing that I was missing completely was that what Glide actually is finding a way to take the most broadly understood programming language, which is relational database, and make it read-write accessible on the most broadly distributed computing device, which is the mobile phone, right? And that is this massive opportunity, which has nothing to do with app building or sort of what I kind of thought it was. And, I kicked myself because I should have known better. A team of that quality wasn't going to go after app building. But I'm glad I took the meeting based on sort of the spike, which was quality of team. And I sort of took my skepticism around what they were doing and let them tell the beginning of the story so that I was able to get actually what they were doing and apply the right lens. I don't know if that answers your question, but that's sort of how I thought about that. Cool. Let me jump through some sort of question structure, tactical interviewing tips, and then open it up for all the rest of the questions if there are any. I just want to make sure I get through this because I think this is actually probably if the stuff before is narrowly around investing, I think this is applicable to any style of investing or maybe even any style of interview. So the first thing I would say is, and this actually is a reflection of work I've done by studying other types of interviewing, and applied it to my work as an investor, rather than looking at sort of the best investors and how they tend to approach things. So one thing just to keep in mind is that the best questions are open-ended. They begin with how, what, where, when, why, and they terminate with a question mark. They're direct, they're open-ended, short, not sort of some big long thing with a preamble and you go on and on and on. The 3 to 5 minute question is terrible. And they're conversation starters that encourage expansive answers that produce sort of more information than you were looking for. and help you kind of round out the full picture of the story, right? I think closed-ended questions are okay, but the use is more limited. So, they're important when you need a direct answer. Like, okay, what is the paid acquisition cost? If someone, it's closed-ended, but it puts you on record, and it allows you to sort of use that as a building block maybe for the next open-ended question. But I think for the most part, open-ended questions are much better. Can you walk me through how you're acquiring customers? And then just stop, let them answer the question. Can you, and then you can dig, well, what does it cost? And you can ask direct questions within that narrative. But I think open-ended questions are far better than closed. And then the thing to really avoid, which I think particularly, again, operators with experience tend to do this, is sort of the double-barreled question or even triple-barreled questions, right? So one, you give the person you're asking a choice of which one do they want to answer, so they can sort of pick, right? Like you say, like, so what's churn and why do people cancel? And now they can pick whichever one they want to talk about, and you're not going to get the answer that you're really looking for. The other thing is, if you sort of say, okay, what would you do if X happened? That's a good hypothetical versus the narrowness of information you gather when you say, if X happened, would you do Y? Now you're much more in a yes or no, or like you've gone down the funnel a little bit. And then even worse is like, if X happened, would you do A, B, C, or D? Right? And that's like the classic operator terrible question, because you're thinking of all the things you might do, and then you're looking for the founder just to like figure out, okay, which one do you think is the smartest? And I'm just going to say that one, because then you're going to think I'm the smartest because I agree with you. But that doesn't teach you anything about the founder. It just teaches you they're good at reading you. And it's not helpful. So I think really trying to be open-ended. Another thing just to think about in general as you hone your interviewing practice is to ask, and I would ask all of you, like, are you comfortable with silence? So that's like 8 seconds. I've gone as far as 15 seconds, and only once have I had somebody see like, are you all right? What's wrong with you? Right? But getting comfortable with silence and asking a question and just shutting up and waiting. People hate silence and they'll fill it, right? And then you just let them talk. So when they you ask a question, what's churn? And they say, oh, well, over the last couple of months, churn's gone down a little bit because, we did this and this, and it's, whatever percent. And if you just look at them, then they'll keep going and talk about why churn was high and what happened that made it that way, or the insight that they had that took churn from 40% to 10%, and what was it that they shifted, and how did that impact the rest of the business, et cetera. And so I think working on the socially awkward thing of getting comfortable with silence is a really important thing to do. So you create space for the founder to talk beyond their talking points. And it makes sense, right? Like, to interview better, you just want to listen more. And it allows you to learn more about the founder rather than sort of, the founder learning more about you. And as you do that, I think it allows you also to remain flexible and sort of listen for hints, little interesting things that suggest questions that you hadn't thought of. And then that leads me to another point, which is, don't be afraid to ask naive questions, right? And even sort of the treading water question as you're trying to understand something, sort of the, well, what do you mean by that? Or why is that the case? That just keeps the person talking and helps you learn more about them rather than like, tying something off and then starting a new topic. When you want people to say more, you can always, the classic, like, repeat their answer as if you're trying to understand it. Like, if I understand you correctly, and then you summarize what you heard, and then they'll always like go one level deeper and sort of continue that thread. When it's bad is when you're afraid to ask naive questions, right? And I think you'll miss tremendous pieces of information, because then effectively what you're going to take away from the interview is a larger percentage your assumptions about the answers, your connections of the dots, rather than the founder doing that for you. And so I think it's really important, when your goal is for you to make a better decision, the belief that if you can gather better information, your judgment will improve linearly. But if you can step change the information that you're applying your judgment to, you can step change the quality of decision making. And so I think being willing to ask those naive questions, being willing to kind of keep the founder talking, and to make sure that the interview is mostly them telling you things rather than you telling them. And then at the end of the day, when you think about your interview, like the goal of gathering that data and asking yourself as you come out of the interview, because this is an iterative process, and unlike actually making investment decisions where like you don't fucking know if you're right for 5 years, 7 years, 10 years, you have no idea, right? And even if you have it looks like you're right, you might be wrong still. Like, things can fall apart. So I think the feedback loops are really long on the actual investments. But the founder interviews, that happens really frequently. And I used to have a practice of and I still will do this, is like sending out anonymous feedback surveys to founders. And that was the information I got back was amazing. Was I prepared? Was I on time? Did I pay attention, etc.? But I think you can also ask yourself some things as you come out of the interview, like, do I understand enough about this company to state my thesis clearly, support it with quotes from the founder, like facts that I go find after the fact, documentation, etc. What are the spikes in this opportunity that get me to a yes? And then potentially, like, what am I concerned about? But having a very specific set of reasons that you're excited to invest and that you can back up with sort of documentation just for yourself, I think is a great practice to know if you're getting better. And you'll realize, like, oh, I don't. And maybe that means you're not ready to make the investment decision. Maybe it means you want to talk to the founder more, or maybe you just make the investment decision anyway. But for the next interview, you do a better job. Do I have enough information to write a coherent list of things I would like to verify or learn more about? Like, did you take good notes on the things that you didn't understand or that sounded off to you that you want to verify after the fact? And then I think, coming out of a meeting, knowing in your heart, like, should I invest my capital? And more importantly, my time. Like, will I look forward to working with these founders? Have I learned enough about them to get a sense of this? And just sort of keep reminding yourself throughout the interview that when you leave, the one thing you're going to do is you're going to make a decision. You're going to decide yes, you're going to decide no, or you're going to decide to learn more. And your job in that 45 minutes, in addition to making the founder like you so you can get in if you want to, is to be able to make forward progress on that effort. And I think a lot of people lose track of that. And so you have a great conversation with a smart person, but you don't actually learn the pointed things that you need to know in order to drive your investment decision. Those are kind of some how-tos that I've picked up from a bunch of reading and then also a bunch of practice across lots and lots of founder interviews. Hopefully that's all helpful. And I'm obviously happy to share whatever, answer questions, or, generally kind of be available, obviously, to all of you. I'm super excited to be spending time in this cohort. And this is just kind of a piece of how I've approached the craft of venture. And it's just one piece. I think sort of the product mindset is the broader thing. And the interview is sort of one piece of that. So hopefully this has been helpful.
Totally. Thank you, Phin. This was fantastic. We're going to open it up to Q&A. Ryan, would you like to ask your question first?
Sure. Thanks. Hey, thanks, Phin. I wanted to ask you, how do you get from being excited about 10,000 investments to only investing in 60? And what does it look like from taking all the information inputs that you have and getting down to an actual yes or no? Is it more like some kind of discussion or consensus, kind of like benchmark, my understanding from the process, or is it more like there's a kind of rigorous checklist like Andreessen Horowitz has?
My process, like, I can talk about the first round process, which was not consensus, but majority. But for me personally, the process is really about looking for those spikes in the founder, in the opportunity, sort of those things that seem almost unbelievable, like the anomalous things. And then, being able to, to believe that those anomalous things and the fundamental understanding that the founder holds are also the things that will provide high leverage to building a massive business. And so, the glide example I gave before, you take that thing, which was it was like almost like that feeling of surprise is what you're looking for. Like, you're in a meeting and you want that feeling of surprise. Like, if right now for all of you, there was a super loud noise behind you and you jump, that feeling you have in your body when that happens, like, that's almost what you're looking for in the meeting with founders, I think. And that you're sort of shocked by something. And then you dig into it and it turns out to be true. And then you believe that truth is the foundation of a very, very large opportunity. And so I think those are the kind of steps to go from, 10,000 to 60 or whatever.
Phin, just to piggyback off that a bit, I wanted to ask you, so of the 63 that you've done, a number of them have turned out great. Some of them, perhaps haven't turned out great yet or didn't work out, and you still thought it was a good bet. And then there's probably even a smaller number, if any, that you're like, well, if I can go back in time, I wouldn't have done it for XYZ reason. Like, even at the time, Yeah. And so, without, obviously, you're not going to name any specific companies or even give it away, but just what are the characteristics of, like, what would you have told yourself in that moment? Like, to the extent that you ever made a mistake in your eyes, what does that look like?
Yeah, so I think the there's definitely those. I mean, there's all of those things. If I look at those 63, and I think in particular, like when you look at like my first 3 years at First Round, it was sort of like it was an education very clearly, and like the multiple on the money that I sort of deployed through First Round in my first 3 years is like 1.23 or something. So it was like it wasn't a zero, but it wasn't like what you look for. The next 3 years, or if you look at the next three, that's where you start to see like the Notions and the Blue Aprons and the Clovers, and that has a great multiple. And then I think as you come into kind of like the last like 3 or 4 years, things are too early, but I think there's some really good potential kind of like large companies in there. And I think the thing I would focus on the most is I didn't early on I didn't appreciate enough the physics of a business and just kind of like the importance of business model, how you're actually going to make money, the friction inherent in that model, and would sort of I think I was pretty good at identifying like the island of innovation that we were all going to live on with the palm trees and the pina coladas and sort of the beautiful life, but I wasn't as good at sort of doing the work to figure out the bridge or the tunnel or however we were all going to get there, and what actually needed to be built. And so there was a company where there's sort of like a fundamental bet on sort of some piece of unit economics that looking back was basically impossible, right? And like that was just a wrong bet. And then I think there are things that were where you make a bet that doesn't work out, right? So like electric objects is one where like didn't work out, but I think when I look at the reasons I made that investment, what I was excited about, the potential there, like I would make that bet again, knowing what I knew at the time, right? And I feel like that was a good investment with a bad outcome. The ones that really kill me are actually so like the first example is one where I made a bet that was just stupid. Like it was just a bad decision, and I was betting on something that I should have known wouldn't come out. I should have known it would end up the way it ended up. Electric objects is one where like I made the bet, it played out in a way that wasn't successful, but knowing what I know, I would make that bet again. The ones that are the worst are the ones where you think you're betting on one thing, but in fact, the thing that either makes a company successful or failure is something totally different that you completely missed, right? And I think those are the ones that really are painful, right? Because you're sort of saying like you're as an investor, you're kind of betting on this thing, you want it to play out this way, you're focusing your attention on that, and it turns out that actually the key driver of this business is something that you weren't even aware of. And sometimes like the tide rises and hides those rocks, and it works out, but a lot of times it doesn't. And I think those are the most painful ones.
Hey, Phin, thanks so much for sharing all this. I think this has been great. How, given all of this and your track record and kind of the stages you shared about your time at First Round, how are you thinking about what you want to do next?
I was joking with Jack earlier that he said, how's solo capitalist life? And I said, the solo part's good. The capital is still in waiting. So I'm trying to figure out, like it's funny. I was talking to someone about investing just as a craft. I know I want to be an investor. Like for me, there's no greater professional joy than seeing something in someone that they don't maybe even see yet and helping them believe it. And then doing everything you can and having the resources either through platform or personally to allow them to amplify their success, right? And to improve their odds of generating tremendous impact. And so for me, that's why to be an investor. The thing that I was saying this, like when you work with other people will absolutely deform your investment lens. Like they will change the way you look at the world. And the question is whether they act as corrective lenses or they make it blurrier, right? And I think there's this process of sort of trying to find people that when they deform your investment judgment, they deform it in a way that makes it better rather than makes it worse. And I think that's really hard to find. So for me, I'm pretty sure I know I want to be an investor. I don't know if I want to do that alone or with others. I don't know if with others means joining an existing platform or starting something and pulling in a group. But very much in the early stages of sort of those conversations, and feeling like I have some ideas around a new platform that has a reason for being. Like my other challenge is like my mental model is the world doesn't need another VC firm. So like it's hard to say I'm just going to go like we all sell coffee and I'm just going to have the best coffee shop on the block. Like I don't want to operate that way. And so I think for me to start something, it would have to have it like a real reason for being, and I have some ideas about that. And then also, there are a couple groups that I think are interesting. Obviously, lots of people I have respect for, but like the combination of respect for, believe in their model, and believe that working with them would both make me a better investor and they would deform my judgment in the right way, and that I could do that for them, is a super, super high bar. And I'm just not sort of through that process yet.
Is there something, as just a quick follow on, is there something either through your time so far at On Deck or not, just in kind of since On Deck has started with this cohort, is there something that has changed for you in kind of more recent time?
Yeah, I mean, there's been a bunch of learning I've done recently. Like I think, a couple mental models I'm playing with right now. One, it used to be that if someone wanted to be an investor and they wanted to raise outside capital, that it was very clear the process that they were going to go through. Like they were going to raise as much as they could for fund one, probably raise a similar amount to 150% of that for fund two. And then fund three was the one that was institutional if they were successful, or they go back to an operating role. Like that was kind of the path, right? And so you kind of had this like 25 to 50, 100 plus was like the success path. In talking with a bunch of folks, sort of through On Deck, as well as just in general, who are thinking about being investors and investing other people's capital right now, I actually think a large percentage of people don't view that as the success path anymore. And that there's a ton of really, really good investors who kind of say, no, I'm good with like 10 or 20 million bucks. I would like to do that. I would like to have the flexibility to fit into rounds rather than have to lead. I'd like to have the flexibility to make one investment a month or 5, depending on how I'm feeling, but not have the need to deploy sort of some amount of capital every quarter, et cetera. And that my desire is to drive multiples, not to sort of aggregate fees. And sort of the shift back to success as successfully operating in this craftsman style. Another just thing I've been thinking about is like most people, I think, believe we're sort of when it comes to the economy or technology, like we're in the 9th, 12th, or 15th inning of the sort of this like expansion that we've seen, particularly in tech. And recently I've been kind of wondering, like, I don't know if this is true or not, but like, what if naturally Amazon is actually a $30 trillion company, not a $2 trillion company, and Apple is a $25 trillion company, and like the exits are in fact much, much, much larger, and that is what we should expect. Like, how will that change kind of the capital stack in the private markets? What does that mean about where you should be investing your time and energy in terms of kind of the practice of venture, and can you drive big multiples at sort of some of the later stages? And I sort of wonder about that, just as I think the idea that exits are not getting bigger but prices are going up is kind of been proven untrue by, like, if Snowflake can go public and be bigger than Goldman Sachs, like I think we should argue the exits are actually getting bigger. And maybe the belief that 15 times EBITDA is the like critical mass, like that is the end state of any company that's public, like maybe any company other than tech-enabled companies. And when you look at like where Nike is right now, based on sort of deciding and declaring that their competitive frontier is digital, not physical, they're seeing their multiple expand. And so maybe the natural state of, EBITDA multiples for tech companies is 30, not 15 or 45, right? And if that's the case, all these companies are actually undervalued today, not overvalued. And like, I'm not saying I believe that yet, but it's sort of this interesting, as I think about having a blank piece of paper and where I want to work, these types of things is stuff I've been thinking about.
Thank you.
Then, can you speculate more a bit on the just on where you see venture going? I mean, you sort of hinted that maybe you see sort of less sort of fat firms and more decentralization, or at first round, you guys were really innovating, sort of like thinking about the platform and firm and productizing venture capital. I'm sure you did a bunch of experiments with data and on sourcing, on evaluating. Where do you see things going over the next like 5 to 10 years?
Yeah, I mean, I think we'll see a continued fracturing of the capital base. Like my general belief is like, just like over the last, call it 10 years for simple numbers, like you saw this explosion of entrepreneurship in large part due to availability of information and access, right? So, we haven't solved a lot of the diversity issues and so forth, but the idea that, being an entrepreneur is not this crazy thing that no one knows how to do unless like you grew up in the Valley or went to Stanford or worked at, some big tech company. And that it is a global movement with lots of information about how to do it and lots of information about how to be really good at it, access to the tools that you need, the resources, mentorship, et cetera. My belief is the same thing's going to happen to investing, and that you're going to see this explosion of, folks allocating capital, and that decentralization will be driven by, access to information, but also just when you break down what investing actually is, access is the primary thing. And so people with access and good judgment should be able to apply capital to that. And I think the world will evolve to allow that to take place. I think at the same time, the reality of kind of the aggregator firms, building up these massive pools of capital means that at some stage, below some stage, they just can't pay attention to you. And so if you want advice and guidance, you're going to need individuals that know what the hell they're talking about. And if they're doing it full time and they can be super helpful and they're dedicated, even if it's a small check, if it's meaningful to them, they will be impactful to the company. And I think entrepreneurs sort of leaning in that direction makes sense. So like a continued fracturing of the capital base, I think will continue.
Yeah, it seems like we're seeing like some people even start like slinging Series A checks as if they were like angel.
No, that's right. I mean, I think we'll see how that plays out. Like right now, my guess is that a huge piece of the bias to take an individual, and this isn't a knock on the individuals that are writing these checks, but I would argue that a huge piece of the bias to take a $10 million check from an individual who you meet with for 7 minutes and who can commit on the spot is the fact that you meet with them for 7 minutes and they commit on the spot. Like, it's impressive. Like, it's, and as a founder, like, holy shit, this person believes in me. And I think it speaks to ultimately what all founders want, which is psychological safety and someone who believes in them as they go through this fucking crazy thing of building a company. And so if you can express that by committing on the spot to a large check, I think it's very, very powerful versus like, I love this. Let's go talk to 10 people that you've never met before and do this whole, like, it's just, it's not worth it. And particularly when increasingly that check from this very large firm doesn't come with a lot of specific attention from a given partner, because as the firms get bigger, even a $10 million check is less and less meaningful to them, right? As a percentage of their capital and what they require to get back. Versus for an individual, I think it is meaningful. Even if they have, $200 million behind them, a $10 or $15 million check is a big deal. And they're going to care and they're going to do work, to sort of make that valuable. So I think.
Phin, how do you think about speed? I remember Josh Kaufman had a tweet that was like, a decade ago, it used to be 90 days between first meeting and investment, and now it's like 9 days. And you just mentioned, 7 minutes for some people.
Yeah.
How do you think about it?
The way I think about speed is I think investors compete on three things: speed, price, and product. Right? And that's what you compete on. And so I think you have to figure out as an individual investor, like, what do you want to compete on? And it's pretty easy to compete on price, which is part of why I'm thinking through this whole, like, what if the exits are actually bigger? And so I think you need to decide as an investor, like, what are your vectors of competition? And how do you define your product? How are you going to compete? What do you offer an entrepreneur? What is your decision process? How fast are you willing to do things? And how can you make sure you set appropriate expectations so that you can exceed them versus have people waiting for you to make a choice? And then on price, I think you have to decide, are you mostly tucking into things, or are you setting price? And then even if you're tucking in, though, it's very, very different to sit with somebody and be like, I'm in for 25K. Like, I don't care, like, you let me know where it prices, but I'm in for 25K versus like, my typical investment's 25K. Let me know as you have terms and I'll tell you if I'm in. Like, those are two very different things. And that's how you play price as an angel. But I think you have to decide, like, how do you want to do it? And it'll impact your returns one way or the other. But you have to make those decisions. So I think when I think about speed, I think a lot of that just has to do with the way you make decisions. And certainly faster is better for a founder. And if you're fighting for allocation, there's tremendous value in that. I mean, for anyone who's raised money, like the investor that you sit with for 45 minutes, who writes you an email that night about how excited they are to invest and they'd love to partner with you. And this is like, where do they sign the safe and where do they wire? Like, that carries a lot of weight. And even if that's not the process you go through, when it comes time to allocating the round and they're looking at that Google sheet and like people's requested allocations and what they're going to give them, I think that early commitment carries a ton of weight.
My understanding was that at first round, Angel Track was your baby. You've seen a lot of, a bunch of angels go through it, and it's, maybe it's been a couple of years now. So you've seen them grow. For sort of angels in this group, what have you sort of seen as sort of like the angel learning curve, or what are some, patterns that you've seen that people accelerate that curve, or what advice might you have based on your experience?
Yeah, so Angel Track really, it was like, Ben and I kind of came up with that, and Ben did most of the work, so he should get a lot of the credit. But yeah, we came up with that, and then now Alex is doing it. She's amazing. The number one thing I would say is angel investing can be very unstructured, and I think the more you can create structure for yourself, the better, right? Part of why I talk about interviewing and having structured interviews is because you want to practice a craft and be able to sort of build on your experience and get better quickly, and so that learning curve will be steeper if you have sort of structured approaches, and you can say, like, I've done this thing 10 times, and the 10th time I did it, I was 5 times better than the first time I did it. Okay, that's good. Now I'm going to focus on something else. In terms of financial structure, I think that's probably the biggest one, where I would guess that people talk about like portfolio and should you have more or fewer companies from a financial perspective. I actually don't think the odd, like if you say like I have, whatever, $100,000 or $1 million, whatever the number is, to invest in companies over the next, year. If you invest in 10 companies or 20 companies, I don't think you're actually skewing the odds that you find the big winner by that much, right? Like you're going from, 0.5% to like 0.75%. Like you're not going from 2% to 25% if you go from 10 companies to 20 companies. So I don't actually think that's the point. I think the reason to do it is because it's just more iteration. It's more times to try something. It's more wash, rinse, repeat. And so I think I would encourage people to have a smaller check size and make more investments early, because anything you lose financially, you're going to make up for that with learning, and therefore get into the next really good thing, and do a better job as an investor. And so I think the number one way to steepen your learning curve is to make more smaller investments. It also lowers the bar on like, how do you win? How do you get in? Like if you have a reasonable relationship and you're not going to be value detracting, like getting $10,000 into a company should be doable. Founders will oftentimes say, oh, you need 50K, but they'll lower the minimum amount. It's totally fine. So I would say like more investments, have the same dollar amount every single time. Like the people who get in real trouble are like, but I was so excited I wrote a 100K check. And you're like, you have no idea what you're talking about. And like at first round, we had a thing where, you'd have conviction sort of like 1 to 5, basically. There was zero correlation between average, like if everything was a 5 versus if it was like a 3.1 to get through, like zero correlation between that score and success of the company. And so I think my view is you really don't know. And over time you develop taste and you start to get a sense. But I think that the early on, a fixed dollar size, a target number of investments, and then doing the work to really be thoughtful about how you're improving your actual craft, your process, rather than worrying about outcomes, is the best thing to focus on.
Phin, if I can jump in here real quick. Thanks for doing this, by the way, and thanks for doing the pitch event as well. So something I noticed just while you were running the pitch event last week and now here as well, you rarely, if not ever, use the word deals to describe your investments. I hear you use the word opportunities a lot, and I definitely love that. How do you think, if at all, that has influenced your mindset and the way that you think about investing in founders?
Yeah, I think I as a product person, like, I started in physical products, and so sort of very obsessive about lots of little things. And, when you're sitting in a factory in China at 2 a.m. arguing about like the added cost of like rolling the leather and stitching it in a certain way, like, you sort of get obsessive about certain things. And so as I've thought about the product that I put in the market, I think, deals are things that are transactional, and ultimately I don't want to be successful by doing good deals. Like, I just don't want to define my success that way. I want to define success by forming unbelievable partnerships with amazing people. And my belief is that, success for me, like if founders that I partner with, when they're done with the company, for whatever reason, either it's a smoking hole in the ground and they need another job, it's a tremendous success and they don't want to be a public company CEO, or more probably, like, for personal, professional reasons, somewhere in between those two outcomes, they decide it's right to step away. Like if in that moment that founder would say, 1, I couldn't have contributed more to the success of the business, I couldn't have been more personally impactful, I couldn't have grown more as a leader, and 2, Phin was instrumental in unlocking that for me, like, that's a great partnership. And I think that if I can form a series of great partnerships, that the financial outcomes will take care of themselves. and that like, because I have so little control of the financial outcome, measuring myself against it is probably not, particularly in the near term, the right way to think about it. And so I think a successful deal is all about the financial outcome. And so for me, I tend to call it, an opportunity or a partnership, because that's how I think of the relationship. And that's the vector by which I measure the success. And obviously, over time, like I need to do some good deals. I need some clear bits and notions and, those things, like you need those. But I think the thing that I have control over and the thing that I can measure is the quality of the partnership. And so I tend to refer to it that way. But it's a reflection of maybe some like OCD product mindset that I have. But I do think that stuff matters. Like when you talk to an entrepreneur, like if an entrepreneur was to overhear you talking about their company and you're talking about the deal, this great deal you found versus this amazing opportunity to partner with her, and she's this, like I think he's much more likely to want to work with you in the second case than the first.
That's it. Phin, thanks again.
If you're an early stage entrepreneur, we'd love to hear from you. Check us out at villageglobal.vc.